Hi, I'm James Robinson, and this is my stock pick of the week. This is our fifth and final video on the company Oil-DRI, symbol ODC. Today we're going to talk about the company's wealth creation characteristics. Now, I look at wealth creation as the primary job of management. Management's job is to enrich the shareholders. There are a lot of different ways that they can do that, dividends, for example, and doing things that make the stock price go up. So what we're doing here is we're really looking at what the management has done which enhances the value of the holdings and the income and wealth of the shareholders. I typically start this section of my videos on the shares outstanding and shares repurchases, shares repurchased by the company. You can see, however, that Oil-DRI has really purchased virtually no shares. In fact, they actually had a net sale of shares over the last 7 or 8 years. So that's an avenue of wealth creation that this company has not availed itself of. Now, there's no obligation for them to do it. A lot of times companies do it because it's a tax advantage way to enrich the shareholders because they own a larger piece of the company without having paid any taxable transaction. But there's no obligation for them to do it. One of the reasons that management chooses that purpose is because it allows them to artificially enhance their results because they're getting more earnings per share just because there's less shares. So the fact that this company isn't buying back shares isn't necessarily a negative. I don't count down for it. Obviously, I don't give them a plus for it, but I don't count down for it. And it does make me wonder that, hey, maybe this management really isn't trying to cook the books. Maybe this management thinks the stock is fairly priced. I mean, one of the things we don't talk about with share repurchases is, are you buying the stock at a fair price? If you're paying too much for the stock, then them repurchasing shares is a wealth loser for the shareholders, right? If what you want to do is be paying the right price or too little, you want to be paying a good price for the stock, not too high a price. So I don't have a problem that Oil-DRI is not rebuying or hasn't rebought stock traditionally. Having said that, I go through this analysis every time when looking at wealth creation. If you'd owned 10% of ODC stock at the end of 2009, you'd have owned about 520,000 shares. Today, through stock sales, your 520,000 shares would mean your ownership in the company has gone from 10% to just under 7.26%. So you've actually had a significant decrease. Now, if you remember when you look back at that slide, you can see that there was shares in 2009 was sort of a low point for the number of shares. They've actually done some acquisitions since then that have caused them to dilute the shareholders, but we got better value for that. So it's not the end of the world, but just understand that usually when you hear me talking about stock repurchases, I'm saying you used to own 10% of the company, now you own 12 or 15 or 20% of the company. And this time it's gone the other way. So you've had a 27% decrease in your ownership of the stock. Again, not necessarily the end of the world. A lot of that happened 10 years ago, and as you'll see, there's good things that have happened to offset that. So the company made about $9.4 million 10 years ago. Last year, the company made $18.9 million. So your earnings per share would have gone from $1.82 a share to $2.46 a share. So it's a 45% increase. So you've had this 45% increase in earnings over the last 10 years. And that's okay, but it's sort of only barely better than inflation. However, when you consider the company pays a dividend and the dividend has gone up every year, you're getting a better return than that. So it's not as bad as it sounds, but in terms of wealth creation, let's just call this a wash. Another way that we look at wealth creation is shareholders' equity. So shareholders' equity is simple. It's the total amount of assets minus the total amount of debts. And the theory is that if that goes up every year, and if the books are legitimate, which we assume they are, then in time, you're going to have the value of the company go up every year, right? So the shareholders' equity has gone from about 80 million to just under 160 million. That is a significant increase. And remember, during that whole time, we've been paid dividends and the company's earnings have gone up every year. And so we're pretty comfortable that this is real shareholders' equity and that will be reflected in the stock price over time. Another way is we look at this is shareholders' equity per share. We do that again because if companies are buying back significant numbers of share, then the stockholders' equity per share might show a much higher number, which would make things even better for the shareholders. But again, this company's bought back no new stock. One significant thing that I look at in terms of a management's ability to create profits for the shareholders is return on assets. So I say this every time, but it's axiomatic that it takes money to make money. And that's true. The question and the measure of a good manager is how much money does it take to make money and how much money does the management make on the money that they've taken. So to simplify things, if you have $100 million in assets and you're able to make $30 million in profits, That's spectacular. If you have $100 million in assets and you're able to make $3 million in profits, that's not so good. So I'd rather buy the company that gets the very high return on assets. And so this chart just looks at that. And you can see that generally speaking, the top 25% of companies, earn about 6.5 or 7% return on assets. This company has kind of straddled that line. It's not spectacular. It's not bad. It's certainly better than the rate of inflation. It's better than most people are able to do with the money otherwise. And so again, I look at this as a marginal return on investment. But when we look at retained earnings, you see this company retains very, very little. So they're able to get a return on assets, but the asset base isn't growing. The other thing that you need to remember here is the return on assets for this company is artificially low. They own 8,000 acres of land, some of which they owned for a very long period of time. They bought that land and it stays on the books at book value, which is the price they paid, minus some depreciation. And so it's probably, almost certainly that land has appreciated in value, and that's not showing up on the assets. That would be a return on assets when they go to sell that land. And so I think that these numbers are artificially low. They're not bad as they are, but I do think they're artificially low because I think that they've got a number of assets that have appreciated, which would show up on shareholders' equity and would show up here if they were to sell. And eventually they will sell because they'll have mined them out, right? This is land that they use to mine the clay out of that they use to make their products. So again, you have to understand when you look at all of these charts and these numbers for the company, you have to also do your homework on the company, read the annual report, and understand what's happening with the company so you can start to make some intelligent guesses about things that maybe aren't showing up on the books, but that are pretty obvious if you think about it. Return on shareholders' equity. The return on shareholders' equity for this company is slightly better because they have a little bit of debt, but they don't have very much debt. When you look at these charts, I've got these straight lines that go across these charts, and those lines, again, are the results that the average typical company gets. So if the roughly 1,000 companies that I've looked at, the top 10% have 30% return on equity, or return on shareholders' equity. The bottom 25% have, a negative return on shareholders' equity. So with this company, first thing you're going to find is almost all of the companies that I buy have a lower than expected return on equity. And that's because my companies don't have any debt or tend to have very little debt. And when you have very little debt, it reduces the amount of, your return on equity is on a larger number because, again, equity is assets minus debt. So if you had the exact same amount of assets as you had on debts, you'd have an infinite return on equity because you wouldn't have any equity, right? So because our companies have no debt, their equity is artificially high relative to the marketplace. So these numbers most of my companies appear to be in the average range, and I'm totally fine with that. So that's where we are with this company with its return on shareholders' equity. This slide is one of the reasons why I really like this company, and it's one of the reasons why I'm very excited about, and I'm not concerned about the relatively small return on assets. If you look at this is retained earnings. So the red line is the annual rate amount of earnings that they are retaining, and you can see that it's virtually nothing. They're retaining almost nothing, which means they don't need a lot of money to keep this little factory producing profits for us. And that means that over time, and by the way, I mean, they've retained virtually nothing in the last 10 years, and they've doubled their earnings. That means they've doubled their earnings on the same asset base. For an investor, that's spectacular. I love that because that means all that money that the company makes in profit can be used to pay down debt, can be used to be invested in growing the business in the future because they don't need it to retain for operations. They can use it to buy back stock, and they can use it to pay dividends. So I love companies that need very little in the way of retained earnings. So this is an A+++ for this company. This next slide is kind of a tool that I use. It's not completely accurate. It's not completely right. It's more just a guideline, and it gives me a sense. So what I do here is I look at the last 10 years retained earnings, and I look at the last 10 years of income, and I say, what amount of income did they make relative to the amount of earnings that they retained? What I'm trying to figure out here is if a company retains a bunch of money, but then they use that money really efficiently, well, I'm okay with them retaining earnings. But even better, if a company doesn't retain very much and they're able to generate high returns on investment, that's even better. So when you see this chart, you'll see there's 10 years of money that they've retained, 10 years of earnings. You take the earnings, you take the income, you divide by the retained earnings over a 10-year period, and you see this number. And you can see that generally speaking, they've been above my 10% threshold. It looks like there were 3 years where they weren't, but many more where there were. So again, this company does a very adequate job of creating a new income off the retained earnings. And it's one of the reasons why I really like this stock. So cash is a very interesting category because you'd like to see a company with enough cash on hand for their operations, plus a rainy day, plus perhaps an acquisition if something really sexy comes along. But you don't like to see them keep much more than that because oftentimes the company can't get a fair return on that money, and that money is holding down the profitability to the shareholders, and the shareholders would rather have the money to do with what they want to do. So it's a fine line, right? How much should you keep? And that's what part of the art of good management. I don't really try and oversee too much what my companies are doing here, but I just want to have a sense of what's happening with the money that the company has a cash on hand. So you can see from 2009 to 2013, this company hoarded a lot of cash. Well, that theoretically makes sense to me because that was in the middle of a recession, and you could see them saying, we need to really kind of keep an eye on things and keep our cards close to the vest. So that shows me they're pretty conservative. Then the recession ended in 2013 to 14. They paid a bunch of money back to the shareholders, or paid off debt, or did what they did with the money, but they didn't hoard cash anymore. They reduced the cash basis to where it had been in 2009. Then after a couple of years, they build it up again, and then boom, they drop it back down. Then a couple of years, they build it back up again. And so that shows me this company is doing a very good job of managing their cash. Now, this alone doesn't tell me that, but this is the sense that I get from looking at this. And then when you look at everything else, you look at the fact that earnings are going up and they don't have a lot of debt, and you just kind of put the puzzle pieces together. This piece tells me this company is doing a very efficient job of managing their cash, which is one of the reasons why, again, I think this is a great company. So the final slide for that I look at, and again, this is one of those things that's more of an approximation. It just gives me a sense for what's happening in the aggregate because there's lots of individual pieces, but you don't know how they fit together. So the things that the company can do to create wealth for the shareholders, they can pay dividends, and that's a known number. They can buy back stock. That's the net amount of stock they repurchase. They can increase their cash. They can reduce debt. And so I like to see what a company's done in every category. So because sometimes there's offsets. When a company pays a dividend, that'll reduce their cash. When a company pays off debt, that'll reduce their cash. And so some of these things are zero sum and some of them aren't. And it's just hard to keep track of it all. So what I do is I look at this and then I say, okay, the orange line is what's happened cumulatively over the last 5 years. Because there's going to be things that bump up or drop down a little bit in category to category, but over a 5-year period, you would expect it to normalize. And so you can see that this company's managed to create wealth for the shareholders at a pretty respectable rate. Obviously, it was better before 2015 than it is now, but it's still, it's still profitable. It still looks like they're making about, $15 million a year in net wealth to the shareholders. And that's $15 million a year. The company makes $18 million in profit. So that's most of the profit is creating wealth for the shareholders. We like that. It's also $15 million a year on a company that has, $300 million of market cap. So it's a nice, relative to the size of the firm. So again, when you look at this company, you do see a lot of things that we really like. Obviously, they're not buying back shares. They've even sold some shares. Most of those share sales happened almost 10 years ago and not really relevant or a problem. Company's growing earnings. We've talked about that. We've already done a video on the dividends. Dividends for this company are great. Shareholders' equity is good and getting better. Return on assets is very good. Return on equity is where I would expect it to be. Retained earnings for this company are very, very small, and they get a good return on the money they are retaining. Cash and cash equivalents seems to be very, very well managed, and there's reasonable amounts of wealth being created. So these are all really good signs. I would give this company a high grade, highest marks for wealth creation. So that's sort of the basic fundamentals for the company of Oil-DRI Corporation. The last thing I do in my videos on wealth creation is I talk about what's happening with my individual portfolio, of which ODC, Oil-DRI is a portion. So we'll talk about that in the next few slides. Here you can see my current holdings. This is as of today, which is December 4th, 2020. And I'm not going to go through each of these individually, but you can see that literally every position I have is up. Many of them are up more than 20%. And so we've done pretty well, especially considering that we're down, by the way, we're up 12.3% for the year, slightly behind the S&P 500. But we're doing great. And remember, we were down 30% at the height of the coronavirus meltdown. So we've had a really good recovery. We managed to buy a bunch of stock. We sold a bunch of stuff that we owned during the coronavirus stuff, and we managed to buy a bunch of stuff at really good prices after the coronavirus hit. And I've created, my portfolio traditionally has had a number of stocks that I buy because I think they're really relatively cheap. When I think the price normalizes, I sell it and I go buy something else because I have limited funds. But because I was able to buy some stocks at great prices, some stocks that I think are really fantastic companies, I've created what I consider to be some permanent or semi-permanent positions. So SEIC, Paychex, Ventas, BlackRock, T. Rowe Price, those are all positions that I consider to be pretty permanent. I would take something pretty surprising for me to sell those. And then also Westwood Holdings, I have just sold my position in that, so my position now is relatively small. That the balance of that is a permanent holding. And what I've done in this case and in several cases is I bought a stock, it went up 20%. I sold my original investment and kept the 20% profit in the stock. And those will be long-term holds. The reason I've done that is I think these are good companies and I think it would be worth holding them for a really long period of time. But I'm still very dubious about this market. I think it's overpriced. I think that, the COVID economy is scary, especially in my industry. And so I just don't want to be heavily invested now. And in fact, I have like 56% cash we'll talk about on the next slide. So I'm doing a lot of hitting and running, but when I'm buying these great companies and and they go up 20% and I sell them, then I'm keeping the profits in the company because I think it's a long-term hold and, why not? So that's happening in a number of my positions. And so that's basically what's going on here. We're up about 13% for the 12.3% for the year as of yesterday and close of business. So here you can see my positions, and you're going to see that I'm currently, I guess, 55% cash. I'm pretty proud that we're at 12% return on investment when since March or April, I've been at March or April, I was 75% cash. But for most of the year, I've been at least 50% cash. And the way I look at that is I found some investments that were just so spectacular, I had to buy them. But I also have been very concerned about the economy. And so I've reduced my risk by 50% and still managed to return the same kind of return as the S&P 500. And I'm very proud of that. I don't know that I'll catch the S&P 500 for the year. But when you look at the fact that my return on investment is based on the entire $150,000 portfolio and $75,000 that's been nicely tucked away in cash, I think we've done very well. I've also created a number of permanent positions that I think will hold for a very long period of time. These are, of the 1,000 companies that I've analyzed, these are in the top 10 companies that I've looked at, and I was able to buy them at prices that I waited years and years to find. So I'm really happy with my results. And again, I'm still hopeful that we'll catch the S&P 500, but it's going to be touch and go if we're able to do that. So finally, here's a look at all my closed positions. These are stocks that at some point during the year that I owned, and you can, pause this and take a look at it, and you can see what I bought, when I bought it, how long I held it, what profits I made. But it's interesting to note the last four positions that I had, because I didn't hold those stocks for very long, and I sold them and made a nice profit. Children's Place, I owned it for 13 days, made a 10% profit. Value Line, Raytheon, and Westwood Holdings, I was able to make a fantastic profit. I made over 20%, and I owned them for 31 days, 28 days, and 95 days, respectively. So did really well on those. And I know they were hit and runs. I know those people I think should be a long-term investor and hold forever. But I've got concerns above and beyond making money on this stock. I'm just concerned about the market, and so I'm still being very conservative. If you wanted to hold all these stocks that I suggest you should buy, I think you'll do fine in them in the very long run. But I've got the flexibility to get in and out, and so that's what I'm doing. So that's it for wealth creation for Oil-DRI Corporation. Thank you very much for watching, and I'd love to hear from you in the comments below. Thanks. So like everybody on YouTube, you'd love to get to the point that you have enough followers that you can make a living off this. I don't think that's really my goal or my dream, but I do enjoy, for some reason, when new people subscribe to my page. It's kind of cool when you see that. And so I've set a goal for myself that I want to get to 1,000 subscribers. That just happens to be the cutoff where you can start making some money. And if I could, make enough money to take myself out to dinner once in a while for a nice dinner, that would be great. Other thing that gives me a real charge is when people tell me where they're subscribing from, and you can see here a map of where my known subscribers are. And by the way, I have to update this because somebody just notified me that they're from Bangladesh. And just to give you a sense, that's pretty cool. I'm sitting here in my office in Phoenix, reading these charts and doing videos, and somebody from Bangladesh is seeing that and is commenting on it. And it's very cool. So if you're watching this and you enjoy the videos, then just in the comments, just write me just a one line. Hey, I'm in, I'm in Sydney, Australia, or I'm in Johannesburg, South Africa. By the way, especially if you're in South Africa, write me, because I don't have anybody in Africa yet, and I'm kind of bummed about it. I want to have somebody on every continent. But please just do that if you would. And obviously subscribe and like. Finally, I put on Twitter my real-time trades as and when I make them. I don't always have time to make videos. It takes some time to make these, to edit them, to put everything together. So what you'll find is that if you want to know when I buy a stock or when I sell a stock, I put it on Twitter, and then eventually get around to explaining, what had happened. And I don't very often explain when I sell a stock, but often when I buy one. For example, I just sold a company today, and if you were to look on Twitter, you'd see that. And I'll talk more about that in a later slide in this video. But again, if you get a second, drop me a line. I'd appreciate it. Thanks.